The dollar continues to dominate the currency market. The greenback is at a 20-year high. A third back-to-back rate hike of 75 basis points by the US Fed and a persistent hawkish tone of its policymakers have powered the spike in the dollar index, leading to the rupee touching record lows. But what is the dollar index and what is its relation with the rupee? My colleague Sakshi Batra here to take you through all the nitty-gritty details.
Well, the rupee is trading near its all-time low levels. It touched a record low of 81.87 on September 26th, and this was because of multiple reasons, the primary reason being the strengthening US dollar, which is now hovering at fresh 20-year highs. But why is the US dollar on a march, putting pressure on the other currencies, including the rupee, which has now crossed this 81 mark as well? Well, the reasons for the sharp rise in the US dollar are flight to safety, dollar being considered as a safe haven amid the fears of recession, and rising dollar yields because of the monetary tightening by the US Federal Reserve. Now, while the rupee has depreciated 8% year to date, the dollar index has appreciated 18.8% over the same period. Remember, but this is not just about the rupee. The other major currencies across the world too, which have corrected against the US dollar as well, from Chinese yuan to South Korean won, the euro, pound or Japanese yen, all have corrected 13 to 20% versus the dollar on a year-to-date basis. Now, what exactly is a dollar index, you ask? The dollar index was created in 1973 by the US Federal Reserve. The US dollar index, or USDX, in simple terms, is a measure of value of the US dollar relative to the basket of foreign currencies. The 6 currencies included in the index are often referred to as America's most significant trading partners, which include the euro, Japanese yen, Great Britain pound, Canadian dollar, Swedish krona, and Swiss franc. Now, the index is currently calculated by factoring in the exchange rates of these 6 foreign currencies relative to the dollar. The value of the index is a fair indication of the dollar's value in the global market. Now, a rise in the index value really denotes that the dollar is gaining, and a fall in the index value denotes a depreciation in the dollar's value. Now, the US dollar index has risen and fallen sharply throughout history. It reached an all-time high in 1984 at 165, an all-time low of 70 in 2007. Now, over the last few years, the dollar index has been relatively range-bound and traded between the 90 to 110 mark. Now, US index has an inverse correlation with the Indian rupee. Whenever we see the dollar index surging, it leads to pressure coming in on the Indian rupee. Now, this index is also affected by macroeconomic factors, including inflation, deflation in the dollar, and the foreign currencies as well. And USDX can also be used as a proxy for the understanding of the health of the US economy, and traders use it to speculate on the dollar's change in value or as a hedge against the currency exposure elsewhere. Now, a dollar is strong right now. It is good news for US but not for the world, because it pushes up the prices of imported food and fuel and medicines, and also threatens to discourage the foreign investment into the emerging markets like India, which actually explains the current correction that we are witnessing in the Indian markets.
If you like the video, do like, comment, share and subscribe.